Aaron Gibbs, President, Chief Investment Officer of Gibbs Wealth Management. Aaron, welcome to Market Overtime. Thanks for coming on the show. Now, maybe I'll start off with a very group to consider here, obviously within this logistic and stock group. But maybe to start with a traditional name in this group, one I think a lot of our viewers would know and probably pretty widely held, and of course that would be FedEx. What's your take on this particular stock, Aaron?
Yeah, so out of the traditional logistic companies, so this is your UPS, your Expeditors, your FedEx, all of those guys, FedEx really does stand out as one of the best companies within that group. And they've been doing very well this year. They're up about 13%, a little ahead of the S&P 500, but they're looking at double-digit growth, profit growth for the next 3 years, very much in line with recovering with the U.S. economy. And their revenues are mostly U.S. based, but they are an international company. But I think this company is good because it isn't overvalued. It's only about $80 billion, so it's a very reasonable price. And as its profits grow, you're going to see that price appreciation. So it's steady, stable growth without an extreme price, and it really is has higher profits and a better outlook than any of its competitors in that space.
Got it. All right. Well, within the delivery and logistics stocks, let's maybe move to food delivery stocks like DoorDash and Grubhub. These are two big names I think our viewers hear quite a bit. Why might these be ones for a long-term investor portfolio, or is it something, or these names they might want to avoid?
Yeah, so this new trend of food delivery, and now we're even talking about, the getting everything within 1 hour. So the 1 hour delivery, we're seeing a lot of new companies come up. The problem is everything that's gone public so far, and some of these companies have very high valuations like DoorDash and Grubhub. They've been very volatile there, and they've missed estimates, or either they've missed the top line, missed the bottom line. They have extraordinarily high valuations for still losing money. And so neither of these companies, either Grubhub or DoorDash, are expected to be profitable until 2022, end of 2022 to 2023. So it is a high risk play. I think there's some safer bets within the new 1 hour delivery area, more about your personal transport versus the food delivery, because to really justify their valuations, these companies need to be as big as FedEx, and they're just not that profitable. They're several billion dollars away. So I think these are definitely more on your high risk, and you've seen the stock prices come down. So I don't think they're quite ready for a long-term investor just yet.
Got it. Some good takeaways there. Delivery, an important factor. I know that Amazon has faced some criticism lately about not meeting their same-day delivery goals, but we'll see how that plays out. Well, Aaron, let's keep going, because I think we'd be remiss if we didn't talk a little bit about companies like Uber and Lyft, the rideshare companies. They've been in the news quite a bit. Now, are these names that our viewers should continue or perhaps consider for the long term, Aaron?
Yeah, these two companies actually are expected to be profitable by this year. They have a better track record of beating their estimates. Lyft has, for the past 2 quarters, has consistently beat bottom and top line, and Uber is at least beating its bottom line, not its top line. But I think on this case, Uber really is the company for the long-term growth. Its revenues are about 5 times the size of Lyft. It's just a much bigger company. It's got a much stronger infrastructure. And as we know, Uber has different products like Uber Eats for food delivery. So they actually compete with some of those other companies, and are just very nimble at being able to really be the dominant player in this new sort of 1 hour delivery world that we're seeing with technologies. So even though they didn't come out of the gate very strong, they've had rough 2 past quarters, and they've been really significantly underperforming year to date. The stock has come down, but at this point, the stock price has come down so much that I think that it's a safer entry point. But be aware that this is a more high risk stock. It will come with a lot more volatility than FedEx, but I think it's one of the players that's going to be one of the dominant players in that space.
Good takeaways, Aaron, on the what maybe was considered ride sharing, but we also have to consider that in logistics and deliveries as well. Looking at the one-year chart, Uber up about 17% going back to its IPO. So it's up slightly, but Lyft, you're right. Since its IPO at 88, it's trading at 55, down about 33%. So some good perspective here. Well, Aaron, we're going to have to wrap it up there. Thanks for sharing your expertise on many of these stocks in that space. Thanks again. That was Aaron Gibbs, President and Chief Investment Officer at Gibbs Wealth Management.